Hey guys, welcome to this week's Money and Investing Show. This week we are talking about the energy space. Is it a bonanza time? Is it a bust time? All will be revealed as we look at the different factors affecting energy prices and how you can profit from them. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter. And one thing I can assure you I'm never shy of is, of course, energy, which all happens to be the topic of conversation today. We're going to talk about the energy bonanza or bust, and key inflection point right now. Does it go up? Does it go down? Plenty of questions.
Certainly is, and energy, I think, is the mainstay of the global economy. So getting this one right is a pretty important call, and we're at a pivotal time, as you rightly say. And I definitely have a very clear view on that, so maybe we might start articulating it.
Well, let's dial it back a little bit. Let's talk about what the energy sector has done this year. It's been the best performing sector year to date. Why is that?
Look, I think, energy it's been the sector that's defied the market. If you look at a chart for equities are down 20-25%, yet the energy sector is up, best part of 30% over that same time frame. And the reason, I guess, for that decoupling is that, energy typically is a reasonably inelastic demand product. What I mean by that, almost irrespective of price, there's a demand for the underlying commodity. And as the world's come out of lockdown, or at least most of the world's come out of lockdown, demand has been picking up quite strongly. And then when you layer over the top of that some issues on the supply side of energy through geopolitics, obviously with the conflict in Ukraine and so on, it's gone to an extent where it's got limited supply, robust demand, and as you know from any level of economic study, if you've got limited supply and robust demand, prices move higher.
Absolutely. It's been the tale all year, and we've made some great money out of the energy market, as I know you have as well. Question for you, AB, the big one at that is, does that continue? So let's talk about maybe some of the factors that may or may not push prices higher, starting with Europe.
Well, look, the whole notion of, can it go higher is such a difficult psychological point to look at when you talk to investors, especially when people are new. If you look at a chart that's, it's pretty much up at its high for the year, you might look at a 12-month chart. You think, well, where else can this go? Actually, true story. Many years ago, it is ridiculous that this is a true story. I had a client on the in the office actually, and they were looking at one of the monitors in the boardroom, and we're going, "Oh, we're recommending this." And they go, "No, you can't buy that. Look how high it is." And so, well, what do you mean? He said, "Like, it's right up. There's no more room left on the monitor for it to go up." And so, change the scale and make it fit. Oh, and now it can go up. And true story. But the reality is, when something looks quite high, it's quite hard for people to hit the buy button, because the widely held misbelief is to make money in the stock market, you buy low and sell high. What's wrong with buying high and selling higher? It's the same problem. You're going to make money, which is great. Plus, if you're using some derivatives work to assist you on the way, it can become a very, very lucrative side of things. So I think energy prices and energy instruments to invest in, whether that be individual stocks, whether it's an ETF, whether it's commodity based investments, they do look quite firm, but I think there's significant upside, and I'll outline the case I think for that right now.
Well, before we go through the opportunities, let's talk about what could push prices higher. So let's start with Europe in terms of their gas situation.
So, Europe is very dependent on Russia for its imports of natural gas, which of course is the main thing used for generating energy and heating. We're going into winter, if it's a cold winter, there's going to be a huge demand for heating and natural gas on the back of that. Yet, if you look at what Germany's got, there's plenty of gas, but storing it is quite problematic. You can't have a couple of boxes of it around the back of your house. The storage facilities take quite some time to build and so on. So Germany actually only has about 2 months of natural gas supply based on its winter consumption.
That's not a lot of time.
It's not when you've had such a massive disruption to your supply. So if we look at the Nord Stream pipelines from Russia into Germany, one is effectively not complete. The other one has been sabotaged or has had decommissioned or an accident of some description that's rendered it not working. So, that's a real problem for Europe. And you could argue that you get your gas from somewhere else, but then you've got to build ports and have the plumbing and pipe work to take it in and storage facility. None of these things are a 5-minute fix. There's a really enormous amount of infrastructure that's required to do that. So on the back of that, the actual spot demand, not stockpiling, but spot prices where you have to buy for delivery now is likely to move up considerably just based on that supply-demand equation. So Europe's in for a tough time, and it already is. I mean, you can see the European equity markets have suffered. We'll exclude the UK from this because that's got its own own series of political problems right now, but certainly, Europe's in for a pretty tough time and having to buy higher energy prices, particularly when you consider energy is priced in US dollars, and we've got that rampant strong US dollar right now. It also means you're not just contending with a higher commodity price per se, but it's amplified by that higher US dollar as well.
Gee whiz, it's tough out there. And that case for gas, as you mentioned, is certainly quite apparent. What about oil? And I guess the segue we can use for this is in the US in terms of their strategic reserves. What's the story there?
Yeah, look, in the US, in Australia, we have a strategic reserve of petroleum. We just keep it in America, which kind of is a bit
quite
of
weird, yeah.
Peculiar, but there we go. So the US Strategic Petroleum Reserve is designed to keep an amount of petroleum on standby in the event of a disruption to supply, calamitous events in the world, conflict, those sorts of things. So to put this into context, the strategic reserves is its lowest level since 1983. Currently just around 400 million barrels and dropping because the Biden administration have just released another 15 million barrels to the market in an attempt, and the reason they're doing this is to try and rein in inflation by keeping commodity prices down. There's a big flaw in that argument, which I'm sure we'll get to in a few moments' time. Now, if you look at the contrast of that, when Biden took office, there were 638 million barrels of petroleum reserve that were kept. So they're about a third of the way through and counting in terms of that strategic reserve. Arguably at a time when geopolitics are all over the place and there's a very real probability of an escalation in the conflict in Europe. You've got China and Taiwan involved with each other. And of course, the crowning glory to all of this is the US announces, we're going to release 1 million barrels of oil a day. So the Saudis cut oil production by 2 million barrels a day. And I guess when you're sitting atop, the world's biggest oil reserve, which obviously the Saudis are, that's a game you're always going to win, because at some point the US won't be able to continue releasing its strategic reserve because there won't be any left. And the Saudis can stymie supply as much as they'd like. And the US has stated that when oil gets down to 65, they'll replenish that reserve. I don't actually see oil getting down to $65 anytime soon, particularly given the production cuts in OPEC. This is very politically motivated. Understand that, and there's been a huge shift in politics on the world stage. With if you think about sort of Russia, China, Saudi Arabia, three countries that are very clearly aligned at the moment, and none of them are really aligned toward US best interests.
So, question for you, AB: does the US have any kind of capacity to be able to refine more oil?
No, that's the other challenge.
That's scary.
Insofar as US oil refining capacity, now you're testing my statistics here, Mitch. The US oil refining capacity is at its lowest for 8 years. And part of that is because of the aged, and I'm not going to say decrepit, but certainly the aged infrastructure that's left in the US now for refining oil. And it's running at, maximum capacity as it has been now for quite some time. And when you have old plants and processing facilities being redlined and working at full capacity around the clock 24/7, things start to go wrong. It requires maintenance shutdowns and things like that. So there isn't a great deal of further refining capacity that they have to refine crude into petroleum, for example. And I think I'm right in saying that at this point in time, there are absolutely no applications for a new refiner in the US. And you can kind of understand why that is. And we've talked about this before, I think, when we discussed black energy. But, given the political landscape and the environmental focus right now, if you're an oil company or a refiner, you're probably not wanting to look down the barrel at, $50-60 billion outlay to build a refinery that may or may not get government approval to operate, depending on the political climate at the time. So that increase in supply of refining, that cavalry is not coming over the hill either.
It's tough when you think about the points we've just made. Limited supply in Europe for the gas, same thing for the US with oil. You spoke about OPEC. So just for the benefit of our listeners there, AB, could you talk to us about what OPEC is and how it works?
Yeah, OPEC is it's effectively it's the cartel. Can you say that? That control oil prices, and it's probably the only legalized cartel in the world. So the group of countries that are members of OPEC, which is the oil producing, exporting countries, and between them is a committee. They decide how much oil they're going to produce and export in the world.
So they control price, right?
Effectively,
basically.
They are able to control the price of the commodity. It's I think it's pretty much the only commodity in the world where it's controlled by a cartel like that. And then outside of that, you've got non-OPEC member countries, Venezuela is an example of that, which are often described as a rogue state because they don't comply with OPEC's production quotas and things like that. They just run their own race. And that may well just prove to be the saving grace for the US if they do a deal with Venezuela. It's only just down the road versus, having oil imported from other parts of the world for them, being in sort of Latin America. And it may well be that there's a bounty of oil that can come in that way. But OPEC have had that ability to control oil prices. And if you think about like the 1974 oil shock and the subsequent damage that did to global economies, that was OPEC just deciding to turn the tap down and export less oil.
And OPEC have cut production by 2 million barrels per day, not to mention the fact, I remember reading, I couldn't tell you the exact numbers off the top of my head, but many of the countries weren't meeting their quotas anyway. Yeah,
well, Russia's part of that, and there'll be others in there as well that drag the chain a little bit because, again, it's if you've got a limited amount of a resource, pumping it out of the ground and exporting it to keep prices low is the exact opposite of really what you want to do. You want to preserve the reserves that you've got and only sell them when prices are at the highest possible price that you can get for it. That's how you make money. And it's a free market, but you can't imagine that OPEC would have that in mind by restricting production and keeping prices high.
Of course not.
Not when oil can be down at 10 or 15 bucks a barrel, but that doesn't necessarily serve the agenda of the producing countries. And as I say, there's a huge shift in geopolitics. The US and the Saudis, for example, through history have had a very strong diplomatic relationship, but really since the Second Gulf War, that relationship I think has been somewhat strained, and so maybe Saudi's not playing ball as much as it used to with the US.
So is this a case of geopolitics across the board, AB, that's really limiting?
I think, it certainly is to an extent. I think, politics and economics, when they're mixed together, never really bode very well for an economy. And there'll be plenty, we could maybe cover that in another podcast rather than sort of politicize this one. But, much for what we've talked about, not being, optimistic and shiny and bright and exciting, the reality is there are some cracking money-making opportunities within the narrative that we've just provided.
Well, let's get into those. So you spoke about ETFs, you spoke about individual shares. Yeah. Where do you start if you are looking to get exposure to the sector?
Look, in these times of higher crude oil prices, owning oil companies is good because from a profitability perspective, because the margin for what they receive for selling their product is much higher, and they tend to do quite well from an earnings and distribution dividend paying perspective. Interestingly enough, most of the big oil companies now have got substantial interest in renewables as well, where they've taken the money they've made from oil and they've divested it into renewables to an extent. So they are very much in that space too. So higher oil prices typically results in a higher profit margin for those companies individually that are there.
Any names that come to mind? Sorry to cut you off.
Phillips, Conoco, you can look at Exxon. I mean, they're the big guys, Mobil. Yeah. They're the big guys. If you're looking in the UK, British Petroleum, all the big guys that are there and well narrated. I think if you then look in the ETF space, which is more directly where I tend to trade. XLE is one of the exchange-traded funds, which is a more broad-based energy ETF. It's had a great run. It's about $83-84 a unit right now. USO, which is the US oil ETF, that one can be a bit of a wild card for people. And I'd be fairly careful. In fact, I mean, you could argue, the energy sector itself is typically quite volatile, and more of a higher risk sector. I think also when you talk about risks in the energy sector, it's more of a risk to the upside than the downside. There's a disruption to production. There's an explosion on an oil platform. We just seen in the US, there's been a hurricane which has restricted production facilities and so on. So there's always more risk on the supply side than on the demand, I think. But USO, that can be a bit of a wild beast, and because of the very nature of how it's made up, which is really futures contracts and that ability to roll futures each and every month costs money to do. So if you look at USO on the grind, it's actually a depreciating asset. So if you held it for 6 to 12 months, it's going to lose value, assuming oil prices don't move over that time, just with the cost of the way it tracks the oil market. Whereas XLE, I think, is a more broad base. You've got UNG if you want to be in natural gas as well.
Yep.
But XLE is working quite nicely for me. The volatility's pretty good. We've got a trade running on at the moment in the ETF Ultimate Investor portfolio for those people that subscribe to it, and that trade at the moment is just looking quite nice, be 2.5-3% for a couple of weeks.
Absolutely. There's so many ways to play it too. A lot of these ETFs also have options markets over them, so you can overlay derivatives with those as well.
Exactly right, and that's really where you can sort of augment your returns a little bit. But just be careful about being short energy at any time, because it is something that can bite you quite badly. There's always risk, as I say, on that side of the coin. I always feel that there's more risk of oil prices spiking higher than spiking lower.
So question for you, AB, if you're an investor right now listening to this and you wanted to get some exposure to the energy market, where do you actually start from a research perspective and potentially as a first trade?
Yeah, I mean, how much research do you want to do? I mean, you can look at charts on the commodity prices and try and make something out of that. You can look at seasonal demand, but all of that requires a fairly keen eye and some fairly sharp tools in order to sculpt out of it a strong view. I think what we've talked about here from a fundamental perspective is a very broad-based bullish case for energy. Even though prices look high, they can indeed go higher, and I think the technicals probably validate that. As I say, a break of 84 on XLE would be quite a nice break of resistance and setting itself up for a further leg up. So that sort of research we've kind of done candidly in this conversation. The question then is how best to exploit it. And oftentimes when people are brand new, they think, I'll just buy some shares in a company, but they may choose a company that hasn't laid off its foreign currency risk and doesn't perform as well as it could or should, versus investing in the broad-based ETF. So if you're brand new, I'd probably take the ETF over the other options that are available there. And as someone like myself that's pretty experienced and a sophisticated investor, that's exactly what I'm doing too. I'm just using derivatives to help put a bit of a ribbon and wrapper around that to augment those returns a little bit more.
Absolutely, and I know you've made some cracking gains this year, so congrats to you. Great analysis, great trading.
Might have to take you out for a coffee on the back of that.
That'd be nice, actually. Should we go there now?
Only if they're using renewable energy to heat the water up.
Or we can go to the pub if you want.
Fair enough too, but no, it's a very, very interesting space, and we're in a very fragile situation right now. And when things are fragile, if you're the US particularly, you'd be fairly concerned about the fact that you've depleted your reserves at a time when geopolitically, given things are quite fragile, that's the time when you probably want to bolster your reserves, not be depleting them. But again, that mix of politics and economics are, no pun intended, oil and water, and probably don't go together.
So energy bonanza or bust. I think this is a pretty clear outcome, pretty clear winner. It's a bonanza.
Bonanza time. Keep making that profit all the way to the bank.
You heard it here first. Thank you, AB. Appreciate your time.
My pleasure, anytime. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.